Alright, welcome back to this video, lesson 15, talking about stop losses, profit targets and position sizing. Just a little talk through what's actually written underneath this video. Stop losses, profit targets and position sizing are all still money management principles, although they have different requirements and rules associated with them. A stop loss is your most important asset protection. Write this down. Do not trade without using a stop loss. Ever. Always place a stop loss. Right? It's amazing how many traders place a trade without one. If the trade goes too far into negative equity, they're too scared to take the loss. Taking a loss is part of trading. You cannot expect to win every single time. If you win 10 trades and take a loss on a trade without a stop loss, it'll take away all of those winnings and more. It's just not worth it, so protect yourself, protect your position. Okay? Yeah, I remember I used to have a friend. He was my boss. He was trading, and he was trading without a stop loss, and it was a United States dollar, Japanese yen, and he was like 600 pips negative. It's just absolutely crazy, and that was like with a full position size. Absolutely absurd. He nearly lost all his money, but he was so lucky that the market tanked it back the other way, and he closed the trade out as soon as it came to zero. What's the point in putting yourself through all that stress just to close your trade out at zero? So always place your stop losses just beyond the move. We'll talk about that on the charts shortly. You have to make sure that whatever you risk is within the parameters of your money management. For example, if 40 pips equals your 3% maximum loss, these are all defined by your standards, then you do not risk more than 40 pips, with the spread included on any one trade. If you do have a signal that you want to trade, you will have two choices: half a position size and double the pips at risk from 40 to 80, or wait for a retracement to your maximum level, or the trade will not go ahead. Okay, that's your options. Your profit targets have different rules associated with them, and the defining factor is your average win. To take the average, you must add up all of your trades, positive and negative, then divide it by the amount of trades placed. You should have a positive number at the end of it. The higher the better, obviously. If you do have a negative number, your profit ratios are off. This means that the profits that you take on an average does not cover the average losses you take. There are two factors to look at here. First of all, look at increasing the profit targets to a suitable expectancy, such as gaining 2 pips for every one you risk, a 2 to 1 risk to reward ratio. That is a benchmark, usually. Number 2 is you're losing too many trades as a percentage basis. This is probably due to you taking any trade setup that you see just coming into action, and just jumping into the market without a proper system, really, or rules. The steps to take to resolve this is to stick to your system. Don't trade every single setup or candle move that you see, and start moving the stop loss to a break-even level once the trade starts moving in your direction. Not too tight though, still give the market room to move. So what I usually like to do is when the price has gone more than halfway, or 30 pips, 20 pips plus, then I'll move my stop to break even. That way it's a free trade. I've got nothing to risk. Even if it gets stopped out, I'll be at zero. But I've got everything to gain from it, so I just leave it open, and that takes all the stress out of it. It's great. So position sizing. It's not to be taken lightly either. When you go through a drawdown period, you're going to be very tempted to increase your position size, which is increasing your leverage. Everybody gets that feeling of fear, which is one of the biggest emotional downfalls as a trader. the fear. What is the fear when you're losing? Yeah, the fear of losses, the fear of not being able to prove yourself to other people. So they're scared of taking a loss, especially if you're in a big drawdown period. They just got the feeling that you have to win. So if you're in a 20 to 30% drawdown period, something that's going to be niggling in your head when you see the next trade set up. You're going to be thinking about doubling your leverage, doubling your position sizes, just to catch up on all those losses. It's an insane thing to do, but that's something that there's a voice inside you that's going to be wanting to do that. So you need to learn to keep these emotions under control. You will never get rid of them. They'll always be telling you to do things outside your system parameters. Just know that they are there, but do not take action based on your emotional thoughts. Although your position size will change monthly when you recalibrate your position based on the account balance, this is the only time to change it. Okay? Or to half it. Okay? Never increase it. So always keep it the same throughout the month unless it is based on the rules previously that you half your leverage, half your position size. Okay, the key is to make decisions of your position size based on sound money management data and stick to it no matter what. The only time you should change your position size is when you need to decrease your position due to large stop losses or reducing risk. Never increase your position size. This bad habit will kill your trading career. Get to know your numbers, your averages, and the position sizing, so it all becomes second nature. And the easy way to do it is to use, once again, my money management Excel spreadsheet, which I've tailored for my trading style and hopefully yours as well. This should fit most trading styles and just about every money management that you need on the spreadsheet. If you got yours yet, I give you the 50% discount code just on the last section there, so it's a great thing to have. So let's have a little look. We're just going to recap over these numbers, still working off the same basis that we were on the last video. Going to have a current balance of $1,000, a leverage amount of 10 to 1, still risking 3% per trade, and the account type is a mini. And we're not going to worry too much about the monthly profit target just now, but what we want to concentrate on, we're going to go for 30 pips is full position size and 60 pips is a half position size. Okay, so on this every $1,000 is going to be one position size and a half is going to be 0.5. Still risking $30 per trade on both. Okay, but I want you to remember these position sizes. So just going to jump over to these charts and let's just have a little look at one of them. Now they're naked charts, nothing much about them. Just going to have a look at them and just go through a couple of possible trade setups. Pretty choppy on the euro lately. Let's find another, something that's a little bit more smooth. Aussie dollar. Okay, so let's just say for instance that, let's just have a look at the longer term. Bit choppy there, and from this period we're down and then up. Okay, so we're going to kind of switch the trends. So let's just say at this moment in time we know we're short, okay, based on a trend line break. Doesn't really matter what it is. Okay, let's just say that you based your trend on this. We know we're short now. Okay, so you come along, get your Fibonacci's, find out that you've just had a bounce off the 61.8 Fibbo right here. Little spike, brilliant. Just get rid of that. So we know we're trading on this candle right here, this green spike, or even better, an engulfing bearish just shortly after that spike. That's a nice little signal there. Okay, but based on the spike, let's have a little look, see what pips. Now that's just a 15 pip risk right there, which is all good. But that's only to the top of the candle. So where do you place your trade? Stop loss, sorry. Rule of thumb would be to go, based on this time frame, 1 hour, I would place it 10 pips above. So roughly about here. Let's have a little look. That's 12 pips. Just move it down a little. Just so it's roughly about 10 pips. Now you are going to have a spread involved in here. So when you're having a look at your spread, let's see where the current is right now. It's about 2 pips, so we always add about 2 pips on to the loss there. So we are now risking 25-26 pips on that trade, which is all good. Considering that a full position size, we would be 30 pip maximum, and what this is doing is actually decreasing our risk from 30 to 25 pips, which obviously works in our profit to reward ratio better. So we're still going to stick with the 30 to 60 pip risk to reward target. So let's have a look. 60 pips is here, 8778. Let's just draw another line in that. 8778. There you go, roughly. Okay, so that is, and then I'll place an entry here. Okay, so you're risking, in this case, 25 pips, but 30 maximum, so you can always move this up another 5 pips if you want to. And our 60% target or potential target is down here. Now you don't have to necessarily put a take profit level in. What we want to do is make sure that before we place this trade, it has the potential for more than double what you're risking. Okay, in this case, a good profit target level would be the low of this move. So it's got a potential to move 83 pips, just say 80. So that's viable to take a trade. Okay, because you're risking 25 to 30, but it's got a potential of 80. So that's a nice little setup for you to take. Let's try and find one that wouldn't be so beneficial. Let's just say this here. Let's just say you were going to place a trade here. I'll just see the figures. Yeah. Let's just say we're going to place a trade here on this green candle, because it's not a great, but just for explanatory purposes, we're going to say it's an engulfing bullish candle. Okay, just after this downturn in a long market. The whole trade setup doesn't matter. I'm just doing it for explanatory purposes. So we would need a stop loss down roughly around here, which is 25 pips. Okay, so we're looking for 50 pip potential, which will be possibly the top of this move, because this is what we have in the recent vicinity. So the top of the last move. So let's just say the chart was here right now, so we're trading right here on the hard right edge, and you've just had a setup here. You're looking to risk 25 pips, so let's see what the potential is on the top of that move. 35 pips. Now that doesn't make the 2 to 1 risk to reward ratio. Now yes, I know the market went up when you would have made a profit, but you don't always know this. Looking in hindsight is always easy. So when you're figuring out your profit potential, you work off the highs, because what may happen in the market was the price will come up and it will test that high and then it'll come back down. Now it might break above that high, that's all good. That's why we don't place a hard take profit all the time, because if the market continues in our current direction, that's all good, we want to capitalise on that. But for the basis of working out the money management risk to reward ratios before you even place a trade, you got to make sure that the profit potential from your entry to the top of the move is more than double of what you risk. Okay, I hope kind of getting that. So this is all worked out before you place a trade. So the hourly close is just about to happen. You're thinking about placing a trade. Put your lines in, where you're going to put your stop losses, where your entry area is, even though the candle hasn't closed yet. It's going to be a rough estimate, and then place the line at the top of the move right here, based on here, and that is your profit potential. Okay, and this is what you're risking, and if this is not 2 times the amount of what you're risking, a 2 to 1, then don't place a trade. Okay, unless you had a retracement down to around this level, which made the money management criteria come into place, because when it came down to about here, you'd be looking at risking about 10 to 12 pips with the potential of a 40 gain, which is all good. You can place a trade only in that factor, but only if it retraced. Okay, so I'll just pause it, go have another scout about, see if we can find any nice juicy trades to have a look at. I'll be back in a second. Okay, so we're going to just have a look at the Euro Japanese yen right now. You can see we're currently in a long market. Okay, making higher highs, higher lows, easy to trade. So this would be a buyer's market at the time. So just want to talk about this move here. Okay, let's say we found an area to trade, whether it be why we trade doesn't really matter. Okay, let's just say it's on this trend line break, counter trend line break. Could have bounced off a Fibonacci, could have bounced off a support, resistance level, whatever, doesn't matter. Let's just say we found this trade. Okay, the low of this move based on this candle, okay, and we're about, let's see how many pips below that is. Okay, we're going to go 14 pips below, thereabouts. Might tighten that up a little bit, although 14 pips would have been better, especially with the Japanese yen. So let's just say we place a trade on this trendline break, on this candle, this little doji candle sticking out of the trend line there. We're going to base our trade on this candle. So we'll be looking at risking right now 35 pips. Okay, so that's outside our maximum 30 pips. So I know I'm going to be half of my position size. Okay, so I'm no longer a 1 full position size. I'll just need to half it to 0.5, so half a position size. But before I even place a trade, I need to work out where my profit potential is. So profit potential is based on this high up here. So the long market, you're buying, you've got your stop loss area, you've got your entry level, and you're looking for your profit potential, which is based on this last high. We're going for the high because it's a long market. If you're going short, you'd be looking for the low. So based from this candle up to the top of the high, it's 149 pips, which is good considering we're only risking 35, but on a half position size. So that would be a viable trade. Okay, let's have another little look. Nice places to go short. I'll pause this a minute. So just stick with the Euro Japanese yen and just invert the chart, so we're actually going on a short perspective now. So we can see we've broke out of a range here defined by these lows. The market's broke through and it's done a little bit of a retracement, and we're looking to get into a trade based on whatever reason you had in this case you had a trend line break. Okay, just remember that you can't see all the candles on the right hand side. You're basing it on this very that's a dramatic candle right there, based on the all the other moves over the last several hours, and then bang, price drops like a stone. But luckily, let's see, so to the top of the move it's a 35 pip, and then we'll just move our position to about around 45 pips, give a little bit of room. And to work out your profit potential, like we said, if you're on a downtrend, we're going to base it on a low, okay, since we're going short. So based on this candle, now we've got the areas put in, I'll pull it over. We can clearly see that the market kept going down, which was great. But entry level here, based on this dramatic candle breaking through this counter trend line. Okay, so risk in 45, profit potential, the last current low 76. It's a little bit off, isn't it? 45, double that, should be 90. Now it was a bit risky, especially in the Euro Japanese yen. Be questionable what you should do. Nice thing to do would have been to wait for a retracement to bring that back up. Unfortunately, this might be a trade that we would have left and missed, although it did actually continue on. This will happen from time to time. Trades don't always meet your criteria, but you know, that's why we have 6 different currencies on, because there's opportunities coming around all the time. And I've explained to you in recent videos that you don't actually need a lot of trades, right? In some cases you only need 5 pips a day to compound your account into an extraordinary amount. So we don't need to capture every single move, we just need to capture the best moves, okay, the most probable and the most favourable for your money management perspectives, okay. So we've been through all the figures with the money management, yeah. Had a little look at the charts and just gone through some descriptions and possibilities. I hope you got the definitions for all these, but always please just make sure that those stop losses come into play. It should be an automatic thing after you place your trade, is to get straight on and place a stop loss right away. But your stop loss levels are defined by your own trading style. I can't tell you how many pips you should be risking because I don't know what trading system you're working with. You might be on a daily chart. In the case of being on a daily chart, you shouldn't put your stop loss 10 pips beyond the candle. You should increase it because within the daily charts there's a little bit more volatility, a little bit more swings and false breaks and whatnot, so you should always leave a little bit of a wider stop loss on that. But yeah, always place a stop loss. It's protecting your assets. It's the most important thing you should be doing. Use my money management spreadsheet to sort out your position sizing. Once you have your position sizes, stick to them religiously. When your account balance is done at the end of the month, whether it's up or down, recalibrate your position size to reflect on your account balance, and just make sure your profit targets they're about 2 to 1. Let's just say, for instance, this Euro Japanese yen trade that we were looking at. Let's just say that because we're risking 45 and then only looking to gain 75, I know it was a half position size anyway, but let's just say you like the move and you wanted to be in the market anyway. What I would do is half your half position size, so now you'd be in the market looking at a potential gain. It'll be a small gain, but on the flip side, if it did lose, you'd only be looking at a small loss. Seeing that will be a quarter of a position size. Okay, so we do have this little thing that we can play about with the position size. If things don't look particularly right in the market, or whether they're too big a swings, we can always half it and then half it again. You've got the feeling that you're still in the market, you're still in with that play, you've still got that potential of getting profit, a little bit of profit, but you know you're only risking a very, very small amount as well, a quarter of your position size. But you don't get that feeling that you've just missed out on a trade. At least you're still in it, quarter position size, and to keep your emotions down, if you want to enter the market on a quarter of a position size, it's perfectly okay. Okay, so next video, what we're going to be talking about ABCD formations and different market types. Okay, so thanks for watching this video, and I'll catch you on the next one.